The Financial Sense Midweek Edition with Jim Paplava. Delving in depth with authors and experts into the key economic issues.
Joining me on the program is Jim Rogers, who's chairman of Rogers Holding. He's also a best-selling author of A Gift to My Children, A Father's Lessons for Life and Investing in Hot Commodities, How Anyone Can Invest Profitably in the World's Best Market. And, Jim, that's where I want to begin our discussion. You cut your teeth in the bull market of the 70s, in the commodity markets, and we were seeing a period of time, we went off gold backing of the dollar. We were seeing a lot of money printing like we are today. How would you contrast the commodity bull market that you see today to the one of the 70s?
Actually, things are similar in some ways and obviously different in others. In the 70s, the U.S. was a creditor nation. Now we're the largest debtor nation in the history of the world. So there's some significant differences. But basically, in my view, the markets are in a similar kind of period. Stocks did very little in the 1970s. They were in a big trading range for 18 years or so. Likewise, stocks have been in a trading range again for the past dozen or so years. The commodities have gone through the roof, just as they did in the 1970s. In the 70s, supply and demand were seriously out of whack for commodities. They're seriously out of whack again. So we're in the middle of a big bull market, and stocks have serious headwinds and serious problems.
You've gone on record in recent interviews that most of your investments are in real assets. We see today the Fed is resorted to several rounds of quantitative easing. We have the Bank of Japan, the Bank of England, and even the Chinese are loosening up. Everybody global central banks are printing money. And, Jim, that's got to be good news for real assets.
Well, it always has been, Jim, so I presume it is again this time, too. Maybe it's different this time, although, as you well know, those are very dangerous words in the investment business or in any business for that matter. Whenever governments have debased currency or reduced the value of the money, something has to go up, and usually what has gone up has been real assets.
Now, a lot of people are talking about China. China's slowing down. There's going to be less demand. If China's strength is weakening, in other words, their economic growth isn't as robust as it has in the past, do you buy that argument, number one?
Well, I do know that China has been trying to cool things off for the past 3 years. I hope it's working. Apparently it's working. It's difficult to read. No, all you know is what you read in the press. But they have been trying to do that. They've had a real estate bubble. They've been trying to pop that real estate bubble. Seems to me that, I know that part is working. They are cooling off real estate. That's going to have some knock-on effects in other parts of the economy. Well, you'll see some real estate developers and speculators going bankrupt in China, but that's not the whole Chinese economy. It's not the way it was in the U.S. when our real estate bubble collapsed. It'll cause problems, but not throughout the Chinese economy and certainly not throughout the world as it did in the U.S.
Now, one thing that we've seen rise year after year during this period of time, and it seems to be the currency of choice, and that is gold prices. Given where gold has been, it's pulled back, although it's still up this year, a little over 5%. We've got silver prices up 15%. Given the problems in the U.S. and Europe, and in particular, a great concern would be the events that are now unfolding in the Middle East, where it looks like we've got 3 aircraft carrier battle groups in the region right now, because I see that I live in San Diego, where we have 4 aircraft carrier battle groups. Jim, what would happen to gold and the price of energy if war was to break out and we were to attack Iran?
Well, I don't think you really have to ask that question. The price of oil is going to go through the roof. Gold is going to go through the roof. I'm not investing in oil or gold or anything because there's going to be war. But if there's going to be war, obviously what's going to happen is those things are going to skyrocket. They may drop for the first day or two, but as soon as people realize what's going on, they will go through.
Now, you've written recently on your blog, if you look at this year financially, we're no longer worried about a double dip. The leading economic indicators have improved. The stock market's up. And there's a sense that things are going well in the United States. And I like to use the analogy, we probably have the best looking house in a bad neighborhood. But you're on record to say the time to worry is not this year. This is an election year, and we all know what politicians do in an election year. They promise the voters candy and lollipops, and they're kissing babies. The time to worry is 2013, and to be panicked by 2014. Explain what you mean by that.
Well, first of all, I should point out, Jim, I don't have a blog. I'm not on Facebook. I'm not on Twitter or any of those things. There are people who have set up accounts in my name, unauthorized, but I just want to be clear, I don't have my own blog. I'm too incompetent or for whatever reason. But yes, every 4 to 6 years since the beginning of the Republic, Jim, we've had recessions or economic slowdowns in the U.S. You can do the arithmetic. So by end of 2012, 2013, certainly 2014, we're well overdue. We'll have another slowdown, another economic problem, perhaps recession, and when that happens, it's going to be worse than the last one because we shot all our bullets. We've gone deep into debt. Our debt is at staggering levels now, and it's getting much higher every day, every hour, in fact. So in 2002, we had a slowdown. 2008 was worse because the debt was higher. The next is going to be worse still because of the staggering amount of debt which we have incurred. Not just us, the whole world.
When you look at this and you see situations like this, why do you think policymakers, because I've read prominent economists both in New York and Washington, they're calling for, you have individuals like Paul Krugman, they're saying that the government should be spending even more money and borrowing more money. Why do you think we failed to learn from history? Because we've seen, for example, in Reinhart and Rogoff's book, This Time is Different, the financial follies that our governments are committing now have been committed by many other governments previously, and they all end badly, yet we've failed to learn the lessons from history.
Well, Jim, first of all, I don't know that politicians have a clue about history, and if they do, it's usually a filtered view of history. They make it read the way they want to, or they think, well, that was then, we're smarter now, we know a lot more now, so don't worry. But the real answer is they want to get reelected. They want to get through the next election, and they hope and they feel that if they can get the next election, somehow or another things are going to get better. It's not. It's certainly not. The situation's getting worse and worse, as you well know, but that's their view, and that's why inevitably, once they go into decline, the decline continues until eventually there's a crisis or a crisis.
Now, we have just seen, or as you've described, a lost decade, at least in the stock market. Stocks are no higher today than where they were, let's say, 10 or 12 years ago. And it reminds one of what went on in Japan, which has seen 2 lost decades. You've been telling investors, prepare for another lost decade. Why do you believe that to be the case?
Well, Jim, it's pretty simple stuff. Our only way to even survive this decade has been by spending huge amounts of money, going deep into debt to prop things up. We're propping up failure right, left, and center, just as the Japanese did, and that has never worked any time in history. You cannot do well by propping up failure. You have to admit your mistakes, take your lumps, and start over again. Unfortunately, we're not doing that in the U.S. We're doing the same thing the Japanese did. You know, the Japanese for 20 years have not let people go bankrupt. You know the expression zombie banks, zombie companies. There are lots of them in Japan, and 20 years later, their stock market is down 75% from where it was 22 years ago. That is not a typo, Jim. The Japanese stock market is down 75% from where it was in 1990. That's going to happen in the U.S. too, because we're doing the same thing. We're propping failure. We're increasing our debt at a dramatic pace. We're printing money.
oh, this may work for a little while, but in the end, somebody has to pay the bills. You're going to run out of other people's money eventually.
You know, something that on the day that you and I are speaking, you're a day ahead of us in Asia, Jim, but Fed Chairman Ben Bernanke was on Capitol Hill, and he keeps referring to inflation being contained and this magic figure of 1.9%. I'm sure that anybody listening to this program would find 1.9% inflation hard to believe. And yet, if you take a look at broad measures of money supply, like M2, it's increasing at an alarming rate. And that, to me, just tells me that there's more inflation ahead of us.
Oh, Jim, you're exactly right. When you said the listeners would find it hard to believe, I think they would find it impossible to believe. They know that inflation is higher than 1.9%. I mean, everybody listening to this program shops somewhere or knows somebody that shops, and prices are up. They're up a lot, whether the government lies about it or not. One of the interesting things is that nearly every government in the world these days acknowledges that there is inflation, except the U.S. We're essentially the only government in the world that claims there's no inflation. Now, I find it incomprehensible that every government in the world, every country in the world has inflation except us in the United States. This doesn't make any sense. We all pay the same price for oil, the same for cotton, the same for copper, the same for everything. So I don't know how much longer the U.S. government's going to get away with being able to tell these lies, which they're misleading all of us. There is inflation. Inflation is going to continue to get worse. We have shortages of all raw materials developing in the world, and we have most governments fanning the flames by printing money. I mean, it's always worked this way. It's simple stuff. As you point out, this has all happened before, and anybody who goes back and does a little homework will know how this is going to wind up. It always has. There may be setbacks along the way. I mean, if suddenly Spain goes bankrupt or something, you might see everything go down in price for a while. But then they'll just print even more money. So you better grab all the real assets you can. If there's war, of course, everything's going to go down for a while. Most things are going to go down for a while, not oil. But in the meantime, prepare yourself because we're having inflation and we're going to have more.
Where are the bond vigilantes in all of this? In the 70s, if the Fed would have made an announcement like quantitative easing, as they've done several times, or Operation Twist, and the money supply would be growing like it is today, the market would pick up on that, the bond vigilantes would show up, they would drive interest rates up. Where are the bond vigilantes today?
Well, they're overwhelmed by the central banks. Central banks around the world are pumping money into the bond market. The Federal Reserve's balance sheet, you'll know that they've been increasing their holdings of interest-bearing securities, likewise in Europe, everywhere. So at the moment, they're overwhelmed by the central banks who have more money than they do temporarily. But eventually, the market always has more money than any central bank or more money than all central banks combined. So they're being overwhelmed at the moment, but it'll come back. I shorted some bonds, long-term U.S. government bonds recently. It doesn't mean I know what I'm doing, because I've shorted them 2 or 3 times in the last few years, only to get stopped out. But I'm back again, taking on the central banks, probably with the same results. But eventually the bond market is going to be finished for years to come.
Do you see this as something that just revolves from one country to another? I mean, the bond vigilantes did show up when it came to the debt instruments of the PIG countries, beginning with Greece. They moved on to countries like Spain, Italy, Ireland, Portugal. Do you see this as sort of kind of a roving market where, the bond vigilantes just show up on one particular country or a series of countries, and perhaps maybe next they move on to Japan and eventually the United States?
Well, yeah, it's not quite that simple, I don't think. I don't think they sort of say, well, who are we going to go to next? As events evolve, people start selling in mass in some countries. Obviously, it became so apparent that Greece was in trouble that everybody sold Greece at the same time. And that's happening as people look around for who else is in trouble. Eventually, yes, it's going to go to Japan. Eventually, it's going to go to the U.S. The Japanese have been able to hold their interest rates at artificial levels for, goodness knows, well over a decade now. maybe 15, maybe even almost not 20 years yet, but certainly for a long, long time. But that, again, is the same thing. Their central bank keeps printing money and buying bonds. This is all going to end very badly, Jim, as you well know. And they have the advantage that the Japanese have the advantage. They don't have to borrow from the outside world. They can borrow internally, so they can get away with it. But eventually, all bond markets around the world are going to go into a secular bear market, and we're going to have 15, 20, 30 years of a bear market in bonds. Now, that may sound strange or absurd even to some people, but look back in history. You will see that in the past several hundred years, the way bond markets have worked, we've had long bull markets. In fact, bonds in the U.S. were in a bear market from 1946 to 1981, and then they turned around. That's, 35 years, and they turned around and went into a bull market starting in 81, and here it is 2012, so that's 31 years later of a bull market. So long, multi-decade bull markets in bonds are not unusual. And when this bull market ends, it's going to turn into a long, multi-decade bear market. So if you're a bond portfolio manager, Jim, I would urge you to get another job.
Now, given what we've been talking about, central banks printing money, we know how this ends, and you're on record that you own real assets, and you just mentioned you're shorting U.S. government bonds recently. Is that how you would play this? You would own, let's say, commodities or commodity stocks. Would you own the commodity stocks versus the commodities?
Well, if you're a good stock picker, yes, you will make a lot more money in a commodity stock. If you know a company that's going to find natural gas or oil in Berlin, you should buy all the stock you can. Then you should call me, Jim, because I want to buy it too. But there are hundreds of natural gas companies and oil companies. But if you're a good stock picker, certainly you'll make a lot more money in a stock, and that's a way to do it. You can also buy commodities directly or ETFs or indexes. There are plenty of ways to invest in commodities, or you can invest in commodity countries. Canada has done better than the U.S. and will continue to do better than the U.S. because it's a commodity country. Australia will do better than Belgium because Australia is a commodity country. Belgium is not. Department store chains in Canada are going to do better than retailers in the U.S. Restaurant chains are going to do better in Australia than they are in Belgium because the whole economy is going to be much better.
Finally, Jim, you wrote a book called Hot Commodities, How Anyone Can Invest Profitably in the World's Best Market. That came out in March of 2007. If you were to look at that book today, would you add any more to it? Has anything changed since you've written that book?
No, the only thing that's changed is prices, of course. Prices are up since then, certainly since I wrote the book and since I started being bullish on commodities again back at the end of the 1990s. I'm sure there would be some nuances here or there, some sentences or even paragraphs, but no, the basic thesis is still the same. We have a shortage of supply caused by a lack of or not enough investment in productive capacity for several decades, and now we have to pay the price. This is another thing which has recurred throughout history. We've had long bull markets in commodities, followed by long bear markets, followed by long bull markets again. People say I'm some kind of smart guy, but Jim, I want you to know I'm not. I just went and looked it up. Anybody can go look it up, and you can see the same thing. It's simple stuff. It's always worked this way. And I guess the only thing I would add is that the situation has gotten worse in that, normally when you're 8 or 10 or 12 years into a bull market, people start adding capacity, whether it's tankers or real estate or stocks or whatever it is. By 2008, we were 9 years into the bull market, and in commodities, and you know what happened. So a lot of people who were thinking of adding capacity have canceled or delayed or rescheduled or suspended. So some capacity which should have been coming on, or normally would have been coming on by 2012, 2013, is not coming on. So the supply situation is getting even worse for commodities going forward. Agriculture is downright desperate almost because, Jim, the average age of farmers in America is 58 years old. In Japan, it's 66 years old. The highest rate of suicide in the UK is in agriculture because it's been such a terrible business. In India, hundreds of thousands of farmers commit suicide every year because it's such a terrible business. And in Australia, the average age of farmers is 58. In 10 years, those guys will be 68 if they're still alive. So, Jim, the world is facing serious, serious shortages in agriculture, and prices are going to go much, much, much higher. Or we're not going to have any food at any price. And if that's the case, then the sky's the limit for food prices.
A lot of people have called for that this bull market in commodities is coming to a close, and several respected analysts. This commodity bull market, as you talked about, began in 1999. It's still going. We're probably in our 13th year. Where do you think we are in this cycle? Because this one looks more pronounced in terms of its longevity than the previous one, because as you just mentioned, Jim, with higher prices because of what happened in 2008, a lot of oil companies canceled some projects, mining companies canceled projects. So instead of making the needed investment to bring and expand capacity, that hasn't happened, which tells me that this market's got a long ways to go.
Well, I'm in the same camp as you. Anybody who says the bull market is over, I would just, first of all, I would suggest they short commodities. That's what they think. But second, and I'm not, obviously, the second thing is I would like to know where the supply is that's going to end this bull market. And if the answer to that is, oh, it doesn't matter about supply because demand is going to go down, well, if demand does go down, governments are going to turn around and print money. That's all they know to do. That's what they've always done, and they will print money. So either way, it seems to me that commodities are the place to be in the investment world in the next several years because of the supply-demand dynamics and or because of money printing. And I don't see it coming, again, to repeat, the best place to be relatively, if nothing else, is in commodities, because if the world economy gets better, commodities will do well because of the shortages. If the world economy does not get better, they're going to print money, and then the only place to be is in real assets.
I couldn't agree more. Well, listen, Jim, I want to thank you for coming on the program, and I just want to put a little plug out for some of the books that you've written. One I thought was rather interesting is A Gift to My Children, A Father's Lessons for Life and Investing, as you impart wisdom to your daughter, and Hot Commodities, which you wrote how anyone can invest profitably in the world's best markets. We've been speaking with Jim Rogers, chairman of Rogers Holdings. Jim, I want to thank you for joining us on the program.
Thank you, Jim. Let's do it again sometime.
All right. Bye-bye.
You can subscribe to Financial Sense NewsHour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/financialsenseonline. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense NewsHour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the NewsHour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Poplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense NewsHour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising with Financial Sense, or arising out of the use of any material on the NewsHour. Be advised that you invest at your own risk.